Welcome back to Understanding VC. I'm your host Rahul. Today my guest is Erik Huberman. Erik is a founding partner at Hawke Ventures, an early stage venture fund that invests 100 to 250K in consumer companies and technology that powers consumer companies. He's also the CEO and founder of Hawke Media, the fastest growing marketing consultancy agency in the United States. And prior to Hawke Media, Erik successfully founded, grew, and sold two e-commerce companies by the age of 26. Now let's talk to him. Hi, Erik. Thank you so much for joining me today.
Yeah, thanks for having me.
Where did you grow up?
I grew up I was born in Los Angeles, but I grew up in a small town about an hour drive north called Ojai, like a small little hippie town.
Yeah. And what were your interests growing up?
Well, main one was guitar. I was convinced I'd be a rock star, so I played a lot of music. And yeah, that was really the big one, but it depends at what age. That was my sort of my childhood interest. I played some sports, but it was never my big thing. I was younger than everyone, so I was a head shorter than everyone. So when I liked playing soccer, I liked playing basketball, but all my friends were a year older than me, and so I was always the smallest guy out there, and so it made it harder to compete. So was never excited about that, but enjoyed it. I like being active and still do. And then I honestly about over time I got really into numbers, and like I don't think if you asked me as a 5-year-old, 6-year-old, 8-year-old, if what are your hobbies, I'd say math and numbers. But looking back, always loved them. My dad really instilled that in me, and like would play games where it's like I have a quarter, a penny, and a dime. How much money do I have? At like 4 years old, you're like scrambling, like, oh God, because you're trying to do, what's 25 plus 1 plus 10, like in your head. So like the mental math, I started having fun with it. Then he got me really excited about collecting enough money to afford the next size dollar bill. So here, it goes 1, 5, 10, 20, 50, 100. So it was like, I'm going to save enough money to have a dollar. Then I'm going to save enough to have 5. Then I'm going to save enough to have 10. Wasn't to buy anything, which I think, I don't think he was thinking as sort of complexly about the thing he was teaching me as it actually came out. But the idea that there was an intrinsic fun to making money and just building to the sake of building versus like the only reason to have money is to buy something really instilled a lot of sort of my frugality and way of growing this business later on, where it's like it became a scoreboard instead of a means to an end. And so I just wanted to like make more and figure out how to like generate more and have it generate more. And so that started really early, like 4 or 5 years old. And then I remember at 8, I wanted my first electric guitar and told him like, I think it was $150. And I was like, I need $150 to get an electric guitar. And my dad's response was, well, get a job. It's like, okay. And that's when I started really figuring out how to make money other than like finding quarters and dimes and, whatever it was to put together to make a dollar. It was actually like, let's go earn some money. And that started at 6. I don't know why, because I really wanted to get to that next dollar bill. So I've told this story before, but I ran around my parents' house and grabbed all the things I decided they didn't need anymore. Didn't talk to them about this, put it in a trash bag, and then walked door to door in our neighborhood trying to sell my parents' stuff. But then, 2 years later, I started doing the lemonade stand thing and buying and selling Beanie Babies and selling flowers and finding ways to actually go make money. And that's what, really kicked that off.
Yeah. I love maths as well growing up. And my mom would, get me to pay for things. So it's a different thing when in comparison to your experience, because it was more to make sure that I'm responsible with money.
Yeah, they talk about it a lot. Like people just don't get it. Like we're, in this economic situation the country's in again with rates going up, et cetera. Like there's a TV show on Netflix out here right now. And I know you're around the world in Singapore, but about, people's, sort of comprehension of investing in money. And, there was a story I saw was, I think the ad for it was the advertisement for the show where someone invested in, I forgot what stock it was, but it was like some crazy stock that went from, they put $20,000 in, all they had, and it went to $100,000. And then they put more in, and it like just kept going up because they're like, wow, this is the best way to make money. We should just do this. Thinking, not understanding that sometimes it goes up and sometimes it comes down, and then they lost everything. And so, and it happened with crypto really heavily. I remember the first time crypto took a dive, like I think it was 2018. I remember sitting at a bar and the bartender telling me that she and her boyfriend had just gone 50-50 on a single Bitcoin. And it was a time, I think it was up to $20,000. And they actually got,
$20,000. Yeah.
yeah, that was the first round. And they bought it because they're like, yeah, it just goes up. You're just going to make more money. And I was with, I know there's a VC podcast. I was with another friend that's big in venture capital. And both of us looked at her like, don't do that. Like, sell it right now. That is, if that, oh, they were saying that it's going to go up. That's going to be the down payment for a house. It's like, if it's a down payment for a house, don't take risk with it. You're taking massive risk. And I don't think people know what that means. They hear the term risk.
Yeah.
And they think, well, yeah, but risk reward. So I'll get high reward too. It's like, no, 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 no. It is actual risk, meaning like you could also lose it all. If you don't, it can go up really high, but it's really volatile is a better risk reward. The better term for that for people that don't understand is volatility. It can go really high, really low, really high, really low. It's like, it can be all over the place, which crypto is great at that. And again, she didn't take our advice. And I know that crypto at that time went from 20,000, I think, down to 3. So it was, you don't want to take risk on that kind of thing, depending on who you are. But if this is like your nest egg, your retirement, like that's, it's important to know these things, and most of the country doesn't. So having parents that instill that in you to like understand this stuff, it's crazy to me, at least in the United States, that they don't teach this in school. Just some basic financial acumen, how interest rates work, like balancing a checkbook, like just some basic stuff.
Yeah. Yeah, I had a similar question to ask. What is something that you can do easily that you're puzzled that others are bad at?
I don't know if I'm puzzled. At this point, I've kind of accepted that we're all different. I will say that up until a few years ago, I kept saying, I'm not that smart, nor is anyone else. And like, the generally people are just not that smart. And, things just come, you get things through being smart enough and hardworking enough. And that's a lot. Malcolm Gladwell talks about that too with outliers, where it's like, if you're smart enough and hardworking enough, you'll be some level of successful. The rest of it's up to timing. Like and you can't time it, you can't predict timing. So I believed that for a long time, but I'm going to be like, not to be conceited about it, but then you start to work. I've worked with thousands of people, and there are tens of thousands. You realize, no. There's smart people and there's dumb people. Like I hate to be shitty, but it's just the truth. I was more, I don't want to say optimistic, but I had a higher view of society for a long time. And now I've watched, you go on Twitter, you want to see the dreads of society and how they respond to things. Like, it's politics. You see this, like people continually voting against their own personal interests for parties that don't serve them. It's continuing to buy into lies, buy into fake news, manage their lifestyles and their money really poorly. And that, I'd say that surprises me. Is like, we all get one life. We all live in the same sort of framework and roles. Why is it so hard to at least take some time to understand the basics in the society? We live in a capitalistic society. Why wouldn't you understand money and how it works? Not saying that everybody has to go try to make as much money as possible. I have many, many friends, and sometimes I feel the inclination to just give it all up and go live on a commune, and it could be just great to live off the earth, and I grew up in a hippie town again. So it's like that's always in the back of my head, is like, I don't need to work this hard. I could just live really simply. And that's everybody's prerogative and choice. And I don't think a measurement of a person's wealth is definitely not a measurement of their success in some senses. But I don't understand why people don't take the time to at least understand the stuff, to at least figure this stuff out. And the other stuff is like, I had to realize like my mental math capacity, because I literally started at 4 years old. I have now, like, I don't have a photographic memory for everything. Like when it comes to imagery, when it comes to words, don't have a photographic memory. Numbers, photographic memory. I literally can see numbers, like, and I didn't know that wasn't something everyone could do. Like, you just assume you're like everyone else. And so like, I can still, like, when visually, if I see a number right now, I can, like, I just glanced over a number in my address bar for this, and I'm not looking at it anymore. I literally saw it for a split second. It's 58137. So, it's that kind of thing where it's like, I don't know where that came from, but that's always been helpful, because now when I'm running a business, I can remember exactly all of our numbers on a P&L from last month, what all the expenses were, where everything was. And so when I'm reviewing our numbers, I can see if something's off without having to go back, look at them side by side, et cetera. I can just go, boom, that's wrong. I know that's wrong. What's wrong with that? Why did we spend more there? Why is that off? What happened? And that makes it way more efficient to be running the sort of like business operations side, because I don't have to like spend hours figuring out where the anomalies are. I can spot them because I have a memory for them.
Yeah. So you run a marketing agency, but then why start a VC fund around it?
Yeah. So really how that got started was I built Hawke Media. I never expected to be the size that it is. And at this point, for those that don't know, we're about 250 people, manage about half a billion a year in advertising. And after the first year, it was making money. And I made money right away, and I was figuring out what to do with it. I started investing in real estate. My whole family came from the real estate business and the waste business. And so I had a little bit of education in it, access to it. And so I liked the idea of that being, it was such a hedge against my business because real estate, really doesn't have a lot of correlation with the marketing and tech industry. So like a time now when things are volatile, I was like, I can own stable real estate. So when my business is volatile, that'll create stability. And over time, that'll be bigger and bigger and bigger. So I really liked that idea. That was my initial plan. And a friend of mine reached out to me and said, hey, we're pivoting our business from media to e-commerce. We want you to be an investor. We're raising some money. And they're really talented guys. And they're like, what will you invest? We want you to invest. And I was like, hey guys, I invest my money in real estate. I'm not going to invest in startups. I spend my time in startups, but that's volatile enough for me. I don't need to also have my net worth in it too. And they're like, no. We're not asking you. You're investing. You can invest as little as you want, but you're going to be an investor in this company. I was like, I appreciate that. All right, fine. And I gave them a small check. That company is called FabFitFun, and it's a multi-billion-dollar company now. And so that was my first angel investment. And I was like, wow, that's a good reason to keep doing it. It's kind of like the gambler that gets a huge win on their first gamble and goes, we're going to chase that. So there's a little bit of a truth to that. But I ended up investing over the course of 3 years in 7 companies off of our balance sheet on my own, and did really well. And so 3 years later, we had an average return of 11x on our investments, which is very, very, very good. And so from there, we decided maybe there's more to this. We had brought someone on to help us run that side of the business. We were also doing a lot of sweat equity deals where we take equity in exchange for services. We found that wasn't great because most people willing to give us ownership in their company for doing marketing services didn't value their ownership enough. And one of my favorite lines from an advisor we had on our first fund, Paige Craig, was invest in the ambition of the founder. Because if they're willing to give you 10% of their company to do the marketing, that means they don't think that 10% is worth anything. That means they're not ambitious. I just gave the second person ever equity in Hawke Media. My partner has equity that he came on and became a partner. We now have a third partner a decade into the business. I don't give equity out like these. I think that's crazy. And so that strategy was, I thought that was, it really highlighted like, yeah, we should focus more on these checks because we're doing well. And so with the guy we had brought on for managing this portfolio, we partnered with him and ended up launching our first small fund, a $5.6 million fund focused, and we built a thesis around it. So we're like, what has done well? Why do we think it's done well? Let's not make this about like, just like, oh, I think that's a cool company, because now we're managing other people's money too. So we have to, if I lose my own money, shit happens, we'll figure it out. If I lose other people's money, it's devastating. So I was like, we need to be really responsible about this. And so we came up with this thesis of like, let's look at some consumer brands that we have access to, because we have all this data and all this knowledge on how they work, that if we see an outlier, we'll invest in it. But I think the majority of our investments should be in the tools and softwares that we use for our clients. Because at the time, I think we had probably 300 clients. And so it was like, and now we're probably double that. And so at the time, we're like, yeah, if we have 300 clients and we invest in a piece of software that they can all use, we can be a strategic advantage to these businesses and actually help them get customers quickly and invest early, but then grow them fast. And so we can make our on paper return very quickly. So if I take a business that's doing $20,000 a month and I can quickly get them to $200,000 a month, well, I just 10x my investment. And then let's go find some bigger investors that can come in and take them to the next level. But we've gotten them from A to B. And now let's get someone to take them to C, D, E, and hopefully we make some money at the end of that. And that became the thesis. And so we did our first fund. It did very well. Turns out, as simple as that idea was, not most VCs don't have a platform to bring to these companies. They have network, which sometimes can be powerful. I don't want to take that away. If you invest in a CPG company and the whole Walmart family, the Waltons, and you can get Walmart to pick it up, you can probably make some money if it's a good product. So we created that and it worked. And so we spent 3 years deploying that fund, did really well. And then we raised our second fund I think we closed it in January of 22, but we basically raised it at the end of 21. And we were able to raise 23 of $50 million. and we closed it. Well, this was within a week. We went out to our existing LPs, some of our network, got the money in, closed, and then the market collapsed and nobody else has wanted to invest since, which has been a good and bad thing for us. It's actually going to be really interesting because we have a long window to raise the rest of the money if we want to, which we're still debating how much more we're going to raise. And this past year has just been a bear to raise. We haven't even asked. We've been making relationships, all that, but people are scared to put money to work. Why that's great is we also have money. So we've been able to invest in really great companies that are surviving through all this at incredible prices because they're all raising. Yeah. What we've seen a lot in the past year in the venture world is instead of these companies going out for a big Series A or Series B, et cetera, they'll just extend their last round and raise a little less money just to get them through this period. But they'll give great terms to the VCs.
Investors.
But it's also not quite predatory because you're not just taking over the company. Like what I don't want to do is like end up owning 80% of the company and the founder owns 20. That's a really bad idea. So they're just raising less money at a lower price. So they're not really diluting themselves very much, but they're getting the money they need to get through it. And those deals have been great because these are companies that we've even done a couple deals where we invested in their last round and they're letting us come back in a year later. The company's double the size at the same price or even cheaper just to keep things going. And it's been solid. Yeah.
I mean, I read about how you assess the tools in the sense you're uniquely positioned, right? Once they're at a certain stage, you can get the tool to be tested on all your clients. And then based on whether it's actually adding value, you can immediately bring them a lot of customers. Am I right when I say that that's how the venture arm fits into your media marketing agency side of things, or is there more to it?
Well, that's part of it is to how can we help onboard customers? Can we again, diligence, as you just mentioned, is really easy because we can use the platforms, go, oh yeah, this is great. Our clients love this, or I don't really see the use case for this. We can actually just do it ourselves. So those two things have been really helpful. The other piece is we also have an ecosystem. We have the network too. All these bigger VCs like to claim, we know all these people. Yeah, us too. We've been doing this for a decade. We can go to every partner and when we find a great new tool, Postscripts are, flagship of an investment. We thought they were going to be the best SMS marketing tool early. I like their attitude. I like the way they thought about business. I like the product. Our team liked the product. We tried it with some clients, and fast forward, we've onboarded hundreds and hundreds and hundreds of customers onto their platform. Our sales team is basically their sales team. They have a great team too. And so we've been able to, be a great partner to them. And we also helped get them in with all our partners. So Klaviyo invested and the founder of Klaviyo, and then Shopify became a great partner and all these other partners. And they've done a lot of it themselves, but we've also helped sort of validate them in the beginning where we already had sort of that that stance in the ecosystem and they didn't yet. And Alex, the co-founder and president of the company, to his credit, he chased me down at a conference. This is now a little over 4 years ago. It was like, you're investing, you're going to be a customer. He was, adamant about it. And I was like, I like the guy. He's a good guy. So we tried it out and then my team loved it. So we went from there.
Yeah. And what do you hope to achieve with the venture arm of the business?
Yeah.
5-10 years down the road.
Yeah. It came from, I think I have said this before, but it came from one thing that we realized was, so we were the first partner to Klaviyo, which is now the biggest email software on Shopify. I think they're valued at 15 billion, or I don't know what the actual number. They're a massive company and they've done very well. They offered me to invest in them when they were worth $5 million. They're a tiny business. We were their first agency partner. My team loved the platform, but I was just getting started. I didn't know how to invest. And I was like, now if our team loves the software and they want us to invest, we're heavily looking at it. That's a very meaningful thing. Back then we didn't have that strategy and we missed it. That would have made me a lot of money. And on top of making a lot of money, which by the way, is a very important part of venture capital. People love to shy away from this, but my job is, we have investors, that my job is to make them money and as much money as possible. So that's important. The other piece of this that I really like is the more we get into this, the more we own the ecosystem. So between Hawke Media and our place in the ecosystem, but we own Postscript, Tapcard, Klaviyo. We did invest in Klaviyo later, Faring, all these tech stack, Cord, all these tech stack around e-commerce. And more recently, we have Superaffiliate, we have ReturnMates, and then Stay Tuned, which is doing a whole roll-up of Shopify apps. So we have so much in our portfolio that we touch now the idea here is the more we can own the ecosystem, the more we can help all of our portfolio companies, and the more Hawke Media can help our portfolio and vice versa. So it becomes this ecosystem play that continues to build off itself and becomes a walled garden, because it's going to be really hard when everybody's working together and you're the new guy. If you're not in, it's a lot harder to compete. And that's part of the strategy too.
Yeah. And while you're raising your first fund, I mean, probably your pitch would have been this, right? Was it really hard to do that? The first fund of 5 million?
Yeah, it's all hard. Raising money is the nightmare part of a fund. Like investing, once you have money, investing, like, don't get me wrong, you have to be diligent, but I wouldn't call it hard. You know what I mean? Like, it's like there's a lot of work to do. You have to be prudent. You have to be smart, but it's not hard. The hard part, because when things, I guess to think about the word hard, it's when you don't have control. You have all the control when you have the money and you're looking at what to invest. Is it hard to work with some crazy founders? Yeah, try to be upfront about that. Try to pick the right founders. All that is important. But with raising money, I mean, especially our size fund, we're raising from high net worth individuals. And individuals are emotional. And so when things are good, they're all in. Hence why, so that's what's funny. Like the second fund is a great example of this. In a week, we raised $23 million. And then in a year and a half since, we've raised zero. Now, we haven't pushed it as hard because we think it'd be probably impractical to like try to close money. But it's like, that's a good example of like, we raised when things were good, everyone's like, yeah, here, go. And then all of a sudden things change. What's funny is we're in a better position to invest. So our fund should do better because of all this. And if I asked any of the people looking at investing, they would probably agree. Like, yeah, now's a good time to invest because everyone's scared and the valuations are down 70, 80%. Do you think they're going to go down another 70, 80%? Probably not. Like, let's look at all historical trends. Like, probably not. And so it's like, this is probably a good time to invest. Yeah, so give me someone to invest. Oh, well, I don't know. Where's the market going? And I've noticed this because I graduated college in 2008. So the last downturn, I was fresh. So it didn't mean anything. I wasn't coming from top and going down. I started at the bottom. So it was like, it didn't mean anything. Now watching my first real down cycle, because I wouldn't even consider the COVID start, like that was just quick fear and it was boop. But a true recession, you realize before this happens, everybody talks about, you want to run in the other direction. You want to invest when everyone's scared. When there's blood on the streets, that's when you should be buying. You hear all this shit. And here we are. And everybody forgets because everyone gets scared and people can't do it. And so like, I'm actually investing heavily right now in a bunch of different things. Before this call, got off the phone with some of my investment managers. Like and don't get me wrong, it might still go down a little bit, but like, if it goes down much, like a ton more, the fucking world collapse and your portfolio doesn't matter. So it's like the idea that people are holding back right now is it's intuitive in the sense that they're chasing like everyone else. They're scared, but you know that like practically we're probably near a bottom. And so this would be the time to invest. And that's something, again, I've learned is like, it is. So again, back to like what's hard about running a venture fund, raising money, because you could get someone on a great day. I literally, one of our first fund, we had a guy say he was going to put in 5 million. He wanted to be half the fund. We were going to raise 10 instead of 5.6. And he's like, right, great. And then he backed out because of some problem with a real estate property was selling that he needed some liquidity and he couldn't actually dedicate it. And he didn't end up doing it. It had nothing to do with us. And that's the crap you deal with when you're raising money. It's like, and I've just never been that guy. Like if I make a commitment, I keep my commitments, but a lot of people don't work that way. And I've heard it from many other friends that run funds where it's like, they've had people that just change their mind on the last day, that they get to a point where they've raised $20 million and someone that's putting in 3 or 4, literally on the day they get the paper, they've confirmed, they're like, yes, and the paperwork, they tell everyone, we're good, we've raised 20, we're ready to close. They send the paperwork and 4 million of it goes out the door. Happened to us, a few million bucks when we went to close, backed out after like, yep, we're in, confirmed, in writing. Okay, here's the wiring instructions. Actually, I can't do this. And so it's hurting cats. It's dealing with a lot of people are emotional. So you're dealing with a lot of that. And, but once you get that done, and once you can continue to show returns and build a better network of LPs, it gets a lot easier. And I was at a venture conference recently, and Alexis Ohanian, who started Reddit, went on stage, and someone said, like, do you like being a VC? He's like, yeah, being a VC is way easier than being an operator. Like, let's just be clear, like, woe is me in terms of fundraising. But at the same time, as someone that runs a business and runs a fund, yeah, running a business is 20, 50 times harder than running a venture capital fund.
Yeah. And unlike a fundraising for a startup, you probably have to have a lot more conversation to close a fund, right?
The funny thing about a fund is I'm basically telling a bunch of rich people that I can manage their money better than they can and just trust me. Because you're not showing them what they're investing in. You're just saying, like, I'm a better manager of money than you
Managing.
are in this sector, and I'm an expert. And I get that, by the way, because I'm also an LP in probably 8 funds. And it's the idea is like, some of them are crushing it because I go into sectors that I don't know a lot about or I can't be as beneficial to, that I find experts in that, just like us. Like, we're very focused on MarTech, ecom tech, commerce enablement, like things that we know all day that my LPs don't, and they want to be exposed to that market. And that's the way to think about it. But at the same time, the pitch is kind of, I'm going to manage this piece of your money better than you can, even though you've made a ton of money and you're rich. Like, because that by nature, that's LPs have to be a certain level of wealth in the United States. So it's a hard pitch. Whereas a startup, it's very tangible what you're doing. But again, I don't know that either one's easier, because usually if you're starting a fund, you've got a story. If you're just a random person starting a fund, yeah, you're probably gonna have a hard time. Just like if you have a horrible business idea, you're gonna have a hard time. But if you have something on the business side that really makes sense and you're the person to execute it, you should be able to find money. And one of the biggest challenges I see with startups is like, make sure that you're able to get it to market with your team. Like, the idea that you need to raise money to build your startup, not good. I don't want to invest in you, because by nature, and I know this, everyone talks about this, like, you're going to hit problems. And if every problem you hit, you're going to need to raise more money, you're probably going to die, because you're going to hit a period like the last year where you can't raise money. So you got to know how to navigate through your business without money, and money should be the growth factor. And that's what we look for. That's what any founder should be looking for, is where can I build something that I don't need money to build it, I need money to grow it. And then you're going to have an easy time raising money.
Yeah. Yeah, I think you guys look at least 20,000 MRR before you invest.
Yeah.
That's what I read from your website, at least.
Yep.
Yeah. Yeah. So I recently came across this new concept of a new generation of VCs who are so-called dual threat CEOs, essentially a founder who's running a company, but also running a fund.
Yep.
You can think of the founder of Superhuman or Eric Torenberg, people like that. So you're also a dual threat CEO. So do you think such fund managers can generate better returns when compared to the traditional VC funds who are?
It depends. I'm a firm believer that if the fund doesn't actually have its own strategic advantage, then you're just investing in, you're gambling. And if there are incredibly smart fund managers, whether that's because they have an operational background or not, like, I actually, like, a good example of this is Warren Buffett. I don't know that he has a big operational background, but he's an incredible investor. So, like, same thing on the venture side. I don't know that you need to be the CEO or a founder to be a good investor. Now, are there certain aspects of being a founder, like then the empathy you can have for your founders when you're an investor, the understanding of operational side of things, being able to be a better advisor, potentially, like, these are all things that would make sense if they built a good business. But I mean, I've seen, like, it's funny because, like, and I'm not going to name them because I don't want to disparage anyone, but there's some really high flyer startups that didn't end up selling or doing well, that then the founders went and started a fund. And it's like, I don't know why people gave you money. It sounds like you're not really good at running a business. Like, you were good at raising money, but like you don't want to invest in you. Your investors didn't make any money. Like, you really should avoid people like you, which is not going to be good. So I also think that the past few years, it was so hard to make returns anywhere else. People flooded into venture. And so it was really quick for a lot of people to raise venture funds because there was so much capital trying to look for places to deploy. And that's where I think we're going to see a quick shakeup in the next few years when those funds are through and they go for their next one. When you can get 6% in a treasury bond, why the hell are you investing in venture? Like, it's the interesting thing. I was just at a finance conference the past 4 days, and they talked a lot about this. The view of a lot of the allocators actually is the opposite, which is like the outsized returns are still going to come from private equity and venture because that's where you can get crazy returns, but it's higher risk. So, but for family offices, things like that, it's like if my money's outpacing inflation and I'm making 6% in a bank account, I'm not going to go as heavy into this other stuff. It's when I'm making zero money on my money and inflation's at 6%. That's when I'm like, okay, I got to go put money to work to make sure that I don't just melt my cash. But now that cash can make money, it's a different dynamic. And so I think that caused a lot of these small, micro venture funds and these, I have many friends that sold their companies and whatever, and now they're all VCs. And we'll see how that all plays out. But I think The problem is, again, I don't think by operating a business you necessarily have a strategic advantage as a VC. You might be a brilliant investor, but I like, other than like, that's where I think that we're pretty good at reading people. We're pretty good at investing in good ideas. Like, that's all great. But I don't want that to be the make or break of how successful I am in investing. Am I good at picking them? Because I think we over-index our personal effect and our personal ability to do that, and under-index environmental factors. So what I want to do is have an actual platform that it's not even a question, which is where the Hawke Media partnership comes in. It's like, it's not a question with our investments if we have a strategic advantage. Like, we know we're going to onboard this. And what we do is we test it. We go try it with a few clients. We see if it works, and then we invest and introduce them to everyone and quickly grow them. If you're another venture fund and you don't have something like that gives you a really big unfair advantage when you're investing, I don't know why you're spending time on that. Because frankly, from a historic sense, you're better off investing in real estate or private equity or another asset class. Venture as a whole is not a great asset class if you don't have that advantage.
Yeah. You mentioned about picking. So how do you think, over time you can get better at picking? Is it just experience? I mean, even given the advantage that you have, right? Very few businesses would still make outsized returns.
Totally. Well, and I think you can, yes, you definitely get better at picking over time. And you have to be intentional about it, though, because I think a lot of people, there's a lot of hubris out there. People don't want to look at themselves and go, why did I fail? And I think you have, and I think it's Bessemer that has their, what they call it, the unfund or something. It's all the deals they missed, like the ones they didn't invest in that they should have. We like
anti-portfolio, Bessemer Venture Partners. Yeah.
Who does it? Which one?
Bessemer Venture Partners.
Perfect. It is. Yeah. At least I got that part right. Good. I love that because there's two parts to that. One is so we look at what did we miss is an important thing to look at, and why. If we had the same information today that we did back then, would we have invested? Because that's we missed one great deal that when we were first starting that we got introduced to. It was early, but I was like, we can't help. It was it's called Boulevard. They're a payment platform and management platform for beauty salons, and it's become really good. They've done really, really well. But back then I was like, I don't work with beauty salons. It's a cool idea, but I don't have any idea. I don't know the industry. I don't know anything. I can't be helpful here. Why would I invest in this? Fast forward, they've crushed it. I have the same statement. I have no help there. I would have come along for the ride. And sometimes those are, and by the way, great investment, obviously, but I wouldn't have invested again. My information or my strategy hasn't changed. I still wouldn't have invested back then. So if it came back again, still wouldn't invest. So it's let's be real with ourselves. Did we make a mistake there? Or is it just, we're not going to get those wins? Just we're probably not going to invest in the next Snapchat. That's just not our strategy. And that's you have to stick to that. Unless you have to reevaluate your strategy sometimes too. The other side is when we have any type of failure or something isn't growing as fast. Why? What did we not call here? Is it that we believed in the founder too much? Is it that we thought that, we predicted an idea was going to happen and we were too far ahead? What mistake did we make that we could have avoided, that we could have ended up? And sometimes, again, it's, we thought the founder was great because of XYZ. Maybe those aren't indexes we should be looking at. Let's readjust that. Or no, how could we have known that the whole world was going to shut down in a pandemic and not allow for this type of advertising, something like that. So it's those kind of things that it's given the information we had then, now that we know what we know now, would we have made a different decision? Again, putting ourselves in that shoe. Obviously, hindsight's 2020. You can always go, I wish I invested 10 times as much money in our winners and didn't invest in our losers. That's always going to be the case. But it's rewinding with the information I had back then. Do we change our way we look at things? And we have absolutely changed the way we look at things. One of the strategies that changed from fund one to fund two is, again, this diligence process is super important. But we found that we lost a couple deals that didn't want to wait for us to do all our diligence and use the platform and all that because things were moving fast. But we didn't want to get rushed into investing. That's a bad idea too. So we found this middle ground where we put a small check in because we have a bigger fund now. We'll put a small check in to show skin in the game and commit. Then we'll do our diligence. And after a few months, we decide whether to double down or not. And so that's allowed us to get in. And when we don't double down, it doesn't necessarily mean the business is a bad idea. We have some great companies that have a ton of markup that we just put that small check in. But it means that we have found that we aren't going to be that strategic advantage.
Yeah. And you also don't invest in consumer brands.
Not often. We have.
More tools.
Not often.
Yeah. Yeah. Why is that? Is that not a venture backable thing?
No, I think it's venture backable. I think and I'm an adventure. I'm an LP in a fund that focuses on consumer brands. I don't think that there's not room for investment. I don't have a strategic advantage. That's the problem. So I'm in a fund that was founded by one of the biggest recruiters, and I'll just say it. It's called Family Fund, and it's the guy that ran Snack Nation, the guy that ran Force Brands, which is the biggest recruiting platform in CPG, and the guy that started Vital Proteins and sold it. I think it was bootstrapped for 1.7 billion. I think was the number. So three really talented guys in the CPG space that have distribution, all the knowledge of the market, all the connections, all the relationships that know this space. With us, I can do the marketing, but that's not an advantage because I'll do your marketing either way, whether I invest or not. So it's not necessarily like by me investing. And so the only advantage I have in that space is I can see, you look at the data and see how a company's trending compared to its cohort. We have Hawke AI. We have 8,000 companies marketing data, revenue data in real time. So I can underwrite it, but then I need data, which means it has to be later stage. Well, I haven't raised a $250 million fund to do later stage investing. So like, I would think that we probably have an advantage in the Series B, but we haven't built that, strategy yet. And so for a seed fund, it like seed and CPG for where I can't get them to market any different than I can get anyone else to market. Whereas this other fund I invested in has that advantage. So generally it's just, and we have done some Series A CPG companies, but generally it's, again, we're going to need more data for us to have an advantage. So it's more of a individualized thing than a fault of the industry, because there's a ton of money to be made in CPG, obviously.
Yeah. I think M13, I spoke to M13, Carl Lomer. So for their first fund, their focus was on like consumer DTC, consumer brand, because their thesis was that, there's an opportunity here with Google and Facebook marketing to really scale up really fast.
Yep.
And that arbitrage just went away like a few years back. So then they started focusing on similar to what you're doing on tools, because these are enabling stuff. So maybe I thought that was a similar thought.
Yeah, no, I actually, by the way, I'm an LP in M13 as well. So I know those guys very well. And they're the founders are investors in Hawke Ventures. No, I think that there's still, you want to be careful chasing the hype too. Like everything in e-commerce is hyped. Everyone started investing. Everyone got hyped on tools. Everyone started investing. And we rode that wave because we get in early. So we find these tools early that we know are going to be the winners. And then everyone else jumps in, and that's been a great ride. But I do think right now, CPG is trading really inexpensively. So you can get into these great deals pretty cheap. And that's part of it too, is the valuation side. You're talking about, financial engineering in some senses too, where it's as long as what you invest in and it can be worth more than that, that's what you're trying to do. And that's where, compared to public markets or real estate, that's where venture can really win, because you're talking about crazy numbers. You're talking about multiples. You're talking about 10xing your fund. You don't 10x a real estate fund. That takes decades. That's not a thing. Whereas venture, that's actually a real thing and something you're shooting for, and you can do it. And so when you're talking about investing in, again, consumer, if you're investing in a company at a 1 times revenue valuation, and they're at 5 million in revenue, and you're putting in a $5 million valuation, and then you've got strategies to get them into stores and stuff and get them to 30, again, you can six it. And at 30, they're not worth 1 times, they're worth 3. So you went from 5 million to 90 million in a couple of years because you were able to help them with distribution. That's the kind of thing where that works. People do it a lot. So it don't, and I shouldn't over index it. There's also a lot of failures, a lot more failures than successes, but it does happen. So I don't think there, I don't know that there's people, I think right now people are backing off of consumer because they were treating it like technology. And I think that's crazy. But I do think that there's a lot of money to be made there once everything comes down to earth, so to speak.
Yeah. So what are some of the trends in commerce enablement that you're excited about right now, and why?
I think AI, and what I love about AI is I think any company that it's funny because I've had this debate with a lot of VCs. I think investing in AI is like saying I invest in the internet. It's it's ubiquitous. It's already commoditized. Everyone has access to it. So if you're investing in a company because their thesis is AI, I think you're fucked. Just to be blunt, I think you're good luck, because everyone's going to be able to do what they do, but they're going to have other opportunities. What I'm looking at is how are all of our companies going to leverage AI? So I really do believe it's kind of like saying the internet, where it's I'm not investing in the internet. I'm investing in things on the internet, sure. But calling yourself an internet company as well. That was a big thing in 2001 or 2000, like you don't want to be that. Everything's an internet company. We're all internet companies. We're all websites. Like that's not a thing. So like getting into the root of how it works, the same thing happened with blockchain. It's a blockchain company. Who cares if it's a blockchain company? What does it do? So it's like figuring out what companies are going to use AI to do their things more efficiently, faster, better, et cetera. And we're building tools like that ourselves. We have Hawke AI ourselves. But again, the idea of Hawke AI is automated marketing strategy and benchmarking. Like that's the tool. It uses AI for that. And I think that's important in how to look at it. But I didn't get into blockchain, thankfully, or crypto and NFTs. Like none of that was something I chased. We didn't chase AR and VR, like all these hype trains. I think AI is the first recent hype train that actually makes sense to me, that this is going to do something big. And I don't think it's what people think it's going to be. Yeah, all these people, showing what they do with ChatGPT and how it can create a ton of shitty content for them. Like that's not going to replace marketers. Like nobody, like it's going to get so flooded that all of that's going to be meaningless. So that's not interesting. But there are going to be implications of it that are really meaningful. And that's what we're looking at. I think that's going to have a lot of impact.
Yeah. Cool. This was great, Erik. Thank you so much again for taking the time to do this.
Yeah. Thank you for having me.